Imagine this, you're scrolling on your phone, and with just a few clicks, you buy a piece of a skyscraper in Tokyo, or a little slice of a beachfront villa in Florida. As easy as buying a stock. Well, that's the massive promise of tokenizing real estate. The idea is to transform one of the oldest, slowest asset classes in the world into something digital, divisible, and instantly tradable. So let's dive in. We're going to explore that incredible dream, and then we're going to confront the much more complicated reality.
And look, this isn't some niche crypto fantasy we're talking about. When the CEO of BlackRock, the world's biggest asset manager, says this is the future, you know the institutional hype is absolutely real. The idea of tokenizing real-world assets, or RWAs, has totally captured the imagination of Wall Street. The expectation here is nothing short of a full-blown revolution in finance.
So what exactly is this revolution supposed to look like? What is this digital deed dream all about? Let's break down the core promise of what a truly tokenized real estate market could be.
Okay, so on the left, you've got the process we all know and probably don't love. It's painfully slow, buried under mountains of paperwork, and involves a whole parade of intermediaries, each taking their cut. But on the right, that's the dream. A process that takes hours, not months. Your ownership is represented by a single secure digital token. It's direct, peer-to-peer, cutting out the middlemen. And, maybe most importantly, it's open to pretty much everyone, letting you buy just a small fraction of a property.
And you can see how all these promised benefits just click together. The ultimate goal, the holy grail, is liquidity, the ability to easily buy and sell. And that's unlocked by fractional ownership, which breaks down massive, expensive assets into affordable little pieces. That creates global accessibility. And the whole system is built on the transparency of the blockchain and the crazy efficiency of smart contracts, which basically fire the expensive middlemen. I mean, on paper, it sounds like a perfect system. So, what's the tech at the heart of all this? It's tokenization. You can think of it as creating a digital deed. It starts with formally valuing a real-world asset, confirming its legal ownership. Then, you bridge that information onto a blockchain, and you mint a unique digital token to represent it. And not token, that's your proof of ownership now. And the scale of this dream is just staggering. Boston Consulting Group forecasts that the market for tokenized illiquid assets, with real estate being a huge part of that, could be worth $16 trillion by 2030. That's not just a big number, it's a prediction for a fundamental reshaping of global finance. But, and you knew there was a but coming, does the reality actually match the hype? And this is where our story takes a very sharp turn. Because for all the talk, for all the hype about a liquid, frictionless future, the data tells a completely different story. The single biggest challenge, the brick wall that tokenized real estate has run into, is the liquidity problem.
Now, at first glance, things look pretty great. I mean, this chart shows the total market for tokenized real-world assets just rocketing up to over $24 billion. That's explosive growth, right? It seems to confirm the revolution is well underway. But the devil, as they always say, is in the details.
And this chart tells you everything. Look where the money is actually going. You see that huge orange and yellow chunk? That's private credit and U.S. Treasuries. These are assets being brought on-chain for the steady income they generate, not for active trading. People buy them and hold them. And real estate? It's that tiny, almost invisible sliver way down at the bottom.
Let's put a hard number on that. Of that massive $24 billion market, tokenized real estate accounts for only about $300 million. That's just over 1%. It's crazy. Despite being the poster child for tokenization, real estate is barely even in the game. The dream of unlocking liquidity just isn't happening.
And this quote from a 2023 study is really the final nail in the coffin. Even when a property is tokenized, it's just not being traded. An average turnover of once per year is the literal definition of an illiquid asset. It just sits there. So you have to ask, why? Why is the dream failing to meet reality so badly?
So what's going on here? Well, the issue isn't really the technology itself. The hurdles are much more fundamental. They're structural, they're legal, and they're tied to the very nature of what real estate is.
Okay, the first and biggest barrier is regulation. A token representing a piece of a rental property is, in the eyes of the law, a security. And that means you can't just sell it to anyone on an open exchange like you would with Bitcoin. Trading is gated, meaning it's restricted to this small pool of pre-approved investors who've gone through all the compliance checks. And that immediately kills the dream of a vast, global, accessible market.
Next up, you have the valuation problem. Think about it. Every share of Apple stock is identical to every other share, but every single house, every office building is unique. So how do you establish a fair, real-time price for a token representing 1/1000th of a specific building in Ohio? This uncertainty makes traders really hesitant, and it leads to these huge gaps between what sellers want and what buyers are willing to pay, which just grinds trading to a halt.
And finally, even if you somehow get past the first two hurdles, where do you actually go to trade? There's no NASDAQ for tokenized real estate. Instead, the market is fragmented across dozens and dozens of tiny, siloed platforms. Buyers on one platform can't see sellers on another, and this scattering of liquidity makes it almost impossible for an efficient market to ever form.
So, is anything working? Is the whole idea just doomed? Well, to understand what real estate is missing, it's incredibly helpful to look at an asset that has successfully been tokenized and made liquid, and that asset is gold.
Now, on the surface, they seem pretty similar. Both are valuable physical assets, but their fundamental natures are worlds apart. Gold is uniform and fungible. An ounce of gold from a vault in London is the exact same as an ounce from a vault in Zurich. But real estate, as we've discussed, is the total opposite. It's unique or non-fungible. And this data makes the difference painfully clear. Look at Pax Gold, a really popular gold token. Almost 70,000 holders and over 52,000 transfers in a single month. That is a living, breathing market. Now compare that to BUIDL, BlackRock's tokenized treasury fund. A massive market cap, but only 85 holders and 104 transfers. One is clearly built for trading, the other is built for holding.
So here's the crucial takeaway. The success of tokenization depends massively on the nature of the underlying asset. You can't just sprinkle some blockchain magic on a complex, unique, illiquid asset and expect it to magically behave like a liquid one. The technology simply can't erase the fundamental properties of the asset itself.
So is the dream dead? Well, not necessarily. The industry is very aware of these hurdles, and people are actively working on building the bridges needed to connect today's fragmented reality to that more liquid future.
And experts have laid out a pretty clear roadmap. It involves creating hybrid markets that can balance regulation with accessibility. It means creating real incentives for market makers. Those are the traders who are paid to always be ready to buy or sell to ensure there's constant liquidity. Critically, it requires regulators to actually provide clear rules of the road. And finally, a really interesting idea is collateralization, letting owners borrow against their tokens, unlocking their value without having to sell them at all.
Which brings us to our final question. Is the vision of tokenized real estate a fundamentally broken promise, a misunderstanding of what makes property valuable in the first place? Or are we just looking at the messy, complicated, early-stage blueprint for a market that is still being built? The technology has definitely shown us what's possible, but the hard work of building the legal and financial bridges to get there, well, that has only just begun.